Now we are looking into the first method. First method, comparable uncontrolled price method, cup method, simply called as. So what is this method is all about? The name itself is giving some clue to us. So what exactly this method is going to do? It is actually comparable. That means it is comparing. It is comparing with what? Uncontrolled price. Uncontrolled price. For what purpose we are comparing this? A transaction between the associated enterprises. We are comparing with the uncontrolled price so that we will arrive at a correct arm's length price. What is the correct price? For example, if I take an example here, Infosys is there. Infosys and Wipro. These two IT companies. And Infosys sold some product to its subsidiary in USA, for example, USA. Wipro also sold similar product to unrelated party in USA. So this is a transaction between the associated enterprise. This is a uncontrolled transaction. Now, when assessing officer sees this transaction between Infosys and its subsidiary, then what he will do is he will look into the market and see that where is the comparison for Infosys. Okay, Wipro is the right comparison for the Infosys. Now they will see the similar product there also. Okay, Wipro is selling the same product for 10,000, but Infosys is selling to its subsidiary the same product 9,000. So he will see there is a 1000 per unit gap is there. 1000 per unit gap is there. This 1000 he will add back to the Infosys income to arrive at a revised tax. So this is what in the transaction between the associated enterprise is comparing with the uncontrolled transaction. That method is called comparable uncontrolled transaction method. Now, for example, the cup method, that is, just a minute, I will rub it first and they will explain. The cup method can be internal, can be external. What is internal? What is external? So in the same example, Infosys and selling it to its subsidiary in the USA for 9,000. So internal means Infosys selling to the another customer in the USA unrelated party at 10,000. For example, this is a internal cup, internal comparable uncontrolled price. So in this case, Infosys itself is selling to the unrelated party at 10,000, but to related party it is 9,000. Then 1,000 will be the arm's length price. Sorry, 10,000 will be the arm's length price, and 1,000 will be the income that is added back to the Infosys income, total income. Okay. Now, this is what is external. External is like comparing the Infosys with the Wipro. That is external comparison. That is the external cup method. In this example, 10,000 is the arm's length price and 1,000 should be added back to the income of the Infosys. Now, this 10,000 can be directly taken as arm's length price. The answer is no. So we cannot take directly 10,000 as the arm's length price. I'll tell you why. For example, in this particular example only, Wipro is giving the warranty to the unrelated party. For example, extended warranty of 1 year. But in case of Infosys doing a transaction with the associated enterprise, it is not giving any warranty. Okay, in this case, the warranty related adjustment that we need to take for the amount of 10,000. We need to do that because to make a right to apple comparison, we need to make any differences are there in the transaction. That differences we need to adjust. Similarly, if Wipro is giving any additional discounts. Wipro is giving any additional discounts and Infosys is not giving those discounts. In those market scenarios, we need to adjust that additional discounts also, discount related adjustment also. So we cannot take directly 10,000 as arm's length price. We need to make some adjustments here. Then after making the adjustment, there is one more adjustment will come. What if there is a product pricing differences are there? The accounting practices that applied by the Infosys and Wipro, if there are gaps, that adjustments also we need to do. So there are two adjustments that we need to do after taking 10,000 as arm's length price in this particular example. After taking 10,000 arm's length price, if there are any warranty related, discounts related, or any other transaction level related differences, we need to adjust. That is adjustment number one. Adjustment number two, if there is accounting practices related differences, that adjustment also we need to do. The whatever the amount comes, that amounts can be said as a arm's length price. So I have given here the directly the calculation only, so that you will able to remember it, you will able to replicate the same thing in the examination. So you can go through that. If you see here, first we will take the arm's length price. First we will take the comparable uncontrolled price here. Then we will make some adjustments here for the accounting, for the adjustment for the differences between the international transaction and uncontrolled transaction. That is first adjustment. Accounting practices related adjustment, second adjustment. Then ALP under cup method will come. This is what is cup method.